everyone see me? Can everyone see Phil? Phil, you there? Jump on. Hey, Phil, how are you?
Good, mate. How you doing?
Good. Now, I can just see if you, there's a couple of hands raised there. So just give us a wave if you can hear us clear, and it'll give us a bit of a chance to test the technology. Now, Phil, my heart goes out to you tonight because you're in Melbourne.
Yeah.
You're usually a vibrant guy out there on the street every night, but tonight you're not. So,
well, yeah. Fun fact: I just found out my next door neighbour's got COVID,
oh, that's odd.
and our kids play with each other on a regular basis.
Okay, well, you might need to get checked.
Yeah, I got to get a thing down my nose. So,
well, welcome to the webinar tonight, everybody. And we'll go through a bit of an agenda. Phil Thompson from Thompson Financial Services is with us tonight, and he is one of the advisors on my trusted panel. He helps a lot of our listeners of the podcast with their personal insurances and a few other things. So, Phil, 20 seconds, what else do you do? Like, you're a financial advisor, I trust?
So yeah, financial advisor, as in life or in business?
Whatever.
Yeah, I've got a beautiful wife, 3 beautiful daughters. That's kind of the most important thing about me.
Great. Now, we're going to go through and just get yourself familiar, everybody. And actually, I'll just run a poll because we just want to make sure everyone can use the stuff just while people are still arriving. Where's your nearest capital city? You know, we don't get many people in Darwin.
I can do that poll.
Yeah, I
You allowed me to do it?
Yeah, I allowed you to do it. So.
Well, I'm in Melbourne, just to confirm.
Yeah, so there we go.
This
is there's about 70% of people who have answered it. We'll give it another 5 seconds. Yeah, there's about 40% in Melbourne, 25% in Sydney, 17% in Brizzy, and the rest of you are scattered around the rest of the world. And then I'm going to end the polling now. And if you were too slow, you can jump in on the next poll. Now, throughout the night, we might ask you to raise your hands so we can just have a bit of interaction. And there's also a question and answer box where you can type in a question and other people can upvote the question. So, Phil, if someone has a banger of a question, other people can click, yes, I like that one. And then we can get to them at the end.
Cool.
So there we go. The majority, 38% of people in Melbourne tonight. So
well, of course they are. We're in lockdown. We can't do anything else.
I know. And they're going to an insurance webinar.
Yeah.
So Phil's a licensed financial advisor. If you don't know anything about myself, my name's Glen James. If you're new to the My Millennial Money ecosystem, I host a podcast called My Millennial Money, and I'm now a retired financial advisor. And what we're going to do tonight is, everyone can read, I'm sure. We'll basically just talk about the insurances, the types of insurances, the costs. We've got some questions that you've sent in that I've printed out. There will be some polls to keep it interactive. We want you to upvote your questions, and then I guess we'll answer anything else. But before we go any further, I'd like to begin by acknowledging the darkinjung people, traditional custodians on the land of which our studio sits here, and pay respect to their elders past and present. We extend that respect to Aboriginal and Torres Strait Islanders who are joining us. So our recommendations tonight, they're always pretty simple. We just want you to get your own advice on your own situation. We want you to be encouraged and just look for one thing. What is one thing that you can take away? Whether that is, Glen's a really nice guy and feels a bit narky, or maybe I do need insurance, or I might have too much insurance, or whatever that is, because it is a free webinar and you're not going to get 1 billion things from this tonight, but we just want you to take away one thing from that. And you need to know that anything we talk about tonight is general advice only, and don't sue us. You can see that in the fine print there.
And ask lots of questions.
And ask lots of questions.
Don't walk away being grumpy if you haven't asked any questions.
Totally. And Phil can help you in your own personal situation later. So before we get into it, many of you may have seen this before. It is what I kind of built my whole financial planning, I guess, journey and practice out of, and I'll only spend 2 seconds on it. A lot of people come to a financial advisor and they say, oh, we want a share portfolio or we want an investment property, which is awesome. I want you to have all that as well. And any financial advisor can pretty much do that. A good financial advisor will ask you your lifestyle goals. So it might be, we want to learn to fly, or I can't even type. Learn to fly, or start a family, or save your first home, or save for children's expenses. But I believe a great financial advisor will help you get your foundations in place first. Superannuation is there because everybody who is working has a super account. But I believe you need a spending plan in place. You need to be cashed up and debt free. So we want you to have an emergency fund. We want you to be out of consumer debt. We want you to make sure that you've got your protection plan, and this is what we'll be covering tonight, and also your wills and estate plan. And the reason we want to do this stuff first is everything we do in life comes in and out of our spending plan. So money that funds our lifestyle goes through here, and our future investments. We want to make sure that the cost of this protection is factored into that spending plan. And then we can also look at making some things tax deductible or tax effective and cash flow effective by using superannuation to help pay for that. So we want to factor in this. And then if you couldn't work, or if you had an accident, or there was an income that was lost in the family, the income replacement would flow into your budget and keep things going. So you don't have to sell your properties at the worst possible time or draw down shares. So that's kind of the concept about doing things from the ground up. And doing boring things like insurance first. Now, I'm going to ask a question, and I'll put a poll up. And I think you need insurance, possibly. And again, I can't make blanket statements. I know I'm good at that. But if you're working full hours or a lot of hours, if you're in debt, or if you've got dependents, there's a strong case that you might need some insurance. So I've just launched another poll, and we'll leave the poll up for about 40 seconds or even a minute. And while that's up, Phil, do you want to add anything to that?
Yeah, just on that concept. As an advisor, you got it when you were an advisor. You get questions all the time about investment properties or shares and all these really sexy things. But really, at the end of the day, you can't afford any of that if you don't have an income. And that's kind of the core of, that's my belief, the core of insurance is replacing income if something is to happen.
Yeah, totally.
So if you don't have an income, what's the point of this growth plan, that having 10 investment properties over the next 10 years if you don't have an income to support it?
Yeah, absolutely. So I'm going to end the poll in 15 seconds. It's coming up to almost 90% or 85% of people voting, and we'll take that as everyone's had enough, and I'll share the results. So there you go. Most people are at least working. 56% of people are working, and 30% have at least two of these. So I believe there's a strong case to have some protection in your life. The 3% of people who aren't doing any of that, they could be studying, which is fine. They could be retired, which is fine. They could be a trust fund kid and not needing to work and not have any debt, or have children and just sipping on, Dom Perignon and Verve, all day long. That's awesome. 11% have all three, the magic trifecta. So yes, there is a strong case that we need to consider protection in our life if we meet those things. Now, another interactive thing, and we'll get you to use the chat for this one just to put it in. And not everyone has to do this, but it'll be good to get some examples. Okay, so everyone can see this. So do you need insurance? Here's just another example to just get you in the mindset. Someone could be rich and then goes down the scale to broke. You might be doing just okay. You might be getting your way out of debt and you're trying to get up here. You might be out of debt and really starting to build your wealth around here. So just in the chat, where do you think you are around? Just put in A, B, C, D, E. So, okay, that's cool. So
we've got a C, we've got a B, we've got a C, D, D, C, C, B, B.
Ellie, I'm just writing some random names. They're going really fast.
Right, Caitlin's C as well.
Sorry if I spelled your name wrong, Alison. D is Rumbi. I've got a friend named Rumbi. Okay, C.
Is that your friend?
I'm not sure.
I
didn't see the last name. So based on that, all insurance does, what it does is, if the worst case happened to Alison and her family, and I'll assume she's got a family, it puts a wedge in here to stop her financial lifestyle being worse off. Okay. And everything's relative. The same with Ellie and Larissa and all the people that put C. All insurance is doing is putting a stop in here. So if the worst case ever happened, you're not going to go down to broke. You're not going to, and the same with Rumbi, any further down. And as your wealth grows, your insurance will be reviewed because, and Larissa said, can you please clarify again what C was? I was getting my charger because, Larissa, you're the only person watching, and we will repeat it for you. But basically, it's just a spectrum. It's probably because I wrote her name down. So basically, we're just putting a stop in to stop things getting any worse. Okay. Now, Phil, can you talk to us about the 3 types of insurance that is available?
Yeah, cool. I love this stuff. I geek out over it all day. So group insurance, there's 3 insurance: group, direct insurance, and retail insurance. So group insurance is if you're a part of a group and then there's an insurance policy over that group. So the most common one is superannuation funds. So if you're a part of a super fund, you're a part of that group or that collective of people. And then the super fund will go to an insurance company and say, hey, can you insure all of our people in our group? If you're a part of like a union, sometimes unions will have group cover, like paramedics. There's lots of kind of people in the medical profession that has group insurance. And so it just covers that collective. If you move outside of that collective, you're no longer insured. So if you move away from that super fund, you're no longer insured under that group cover. If you move away from that employer, you're no longer a part of that group. Direct cover is you individually, you go to an insurance company, you say, hey, I want insurance company cover. So you go to an insurance company and you get your own direct cover. Normally with direct, all direct insurance cover, they don't do any medical underwriting. With group cover, they're similar. They don't do any medical underwriting because they're covering the group. Direct insurance, that is generally you just go and you get quick cover, advertised on TV as quick, no medicals, and so super easy to get the cover. And a retail insurance is
that a fair? Anyway, just put that there.
Your words, not mine. So there's a whole bunch of deficiencies with group insurance, and we can get into detail if people have questions about that. Retail insurance is through a financial advisor. And so it's individual policies. So it's a contract between yourself and the insurance company. And the beauty of it is it's medically underwritten. So the insurance company understand what risk they're taking on. And so they're willing to offer you cover for the risk that you pose, whether that be your health risk or occupation risk. So it's medically underwritten at the time that you take out the cover. It's much more time consuming to get that cover than any of the other 2. But it's just in terms of a quality of cover, it's much better quality cover.
And you've also got more flexibility with the tax structures.
Yeah.
So what do I mean by that? So, for example, you could call the direct TV ad saying, we will insure your family for $10 a week or whatever that is. Sure. But the ownership of that policy will be you personally, and that $10 a week won't be tax deductible. But if you went to Phil and said, Phil, I want some death cover for my family, Phil has the option to put that in your super fund, make it tax deductible to the super fund, and then another layer of estate planning, you can actually have more of a guarantee of where you want the proceeds to go. So you've got a lot more flexibility and quality of product. And I don't know about you, Phil, but I used to do quotes on the direct insurance and then look at the stuff that we as advisors could do. And a lot of the time, the retail stuff, it was better quality. We could set it up in a more tax-effective way, and there was more certainty at claim time around a benefit payment and who you want the payment to go to. And it was often cheaper because this direct stuff is highly profitable as well for the companies that are just dishing it out.
And the most important thing is claims.
Yeah.
So I'm just looking on our Money Smart website. Direct insurance cover for income protection, direct insurance pays out on 85% of all claims. When covered through a financial advisor, they pay out on industry average is 96% of all claims. So your claims rate is much worse through direct cover.
Yeah, wow.
But yeah, it is generally more expensive, and I can geek out and explain the philosophy around why it's more expensive. But generally, people cancel their cover, so it's more costly for the insurance company.
Yeah.
So that's generally why it's more expensive.
Before we go into this, let's just do another poll to keep things sexy, and then we'll get Phil to talk to us about the 4 broad types that we'll be talking about tonight. So we're launching this poll. Actually, I wonder if and just talk to us about what your current insurance setup is, if you've got no idea. And hopefully the iPad will stay connected. Okay, so there's some good responses coming in. We'll let it. There's about 75% of people who have completed it. We might go up until it starts to plateau out, usually around the 85 to 90%. And you don't have to answer these. This is the best part about it. It's anonymous.
So there was a quick question from Emma just about the examples of direct cover.
Yeah, sure.
So like the Medibank private cover, and Bupa, I think. So, I mean, there may be confusion. I don't know if Medibank private actually offer direct life insurance, do they?
Yeah, I'm not sure.
A lot of those general insurance providers will sometimes offer some really light kind of insurance, but a retail policy is done through a financial advisor.
Yeah.
So if you've done it through a financial advisor, you would almost certainly have a retail product or a combination of retail and group cover, depending on what the best outcome was.
Yeah, I use the example, and it is getting blurry in the marketplace. Like you can go to Coles now or Woolworths, and Coles and Woolworths are no longer just selling groceries, okay? So they're selling credit cards, they're selling car insurance, they're selling house insurance, they're selling mobile phones, they're selling everything. The way I live my life, and this is just me, I go to Coles and Woolworths for my groceries. Then I go and buy my insurances from a provider that their core business is insurance. So it's, hey, we'll just do your bread and milk. Oh, by the way, do you want some insurance with that? And they're only doing it because they can sell it to you because it's direct. It's like right there and instant at the point of sale. So I would just caution you, not even to do with insurance, like you've just got to really look. Like these businesses have traffic in their shops and they'll capitalize on that. So the same thing with health insurance. Some health insurance funds will allow death cover, but me personally, no, I want you to sort out my health insurance only. I'll get my life insurance from someone who only does life insurance because you'll get a better product. So there we go. So 58% of you just have default cover in your super. That's fine. 5% have no idea. There's 1% that have some direct cover and 25% that they have no insurance at all. And there's 12% that have insurance through an advisor. And remember, just keep upvoting your questions because we'll get to them at the end because some of them will be answered throughout the course of this. So Phil, talk to us about death cover.
Yeah, cool. Death cover is pretty simple. If you're dead, you get paid out a lump sum. There's not too much nuance. I mean, there is like payments for terminal illness that you've kind of written in your brackets, where if you are terminally ill and you're likely to pass away within 12 months, they can prepay that death cover. But it's pretty much if you're dead, you're dead. It's paid out. It's not that difficult.
No.
The next is TPD, so total permanent disability or disability. That means if you can never work again. So if you can never work again, as a lump sum payment. So death cover as well is a lump sum payment. So whether you're covered for $100,000 or $5 million, there's a lump sum. Same with disability insurance or TPD. It's a lump sum cover. So if you could never work again. Trauma or critical illness or crisis recovery or the 17 other different terms that insurance cover companies call it. That's for serious medical events. So if you have a serious medical event such as cancer, heart attack, or stroke, which are the main ones, cancer makes up a huge percentage of claims, then you get a lump sum payment. So again, it's another lump sum payment. So you can be covered for $20,000 or $2 million. It's really up to how much cover you want to and how much cover you think's appropriate.
And then, I guess the reason that trauma insurance was created, people were having a heart attack or maybe being diagnosed with cancer, and the survival rates for many big illnesses are in fact getting less and less as medical advancements were coming along, and they can't claim on their death cover because they're clearly not dead. You could be diagnosed with cancer tomorrow and no doctor can say you can never work ever again because the illness hasn't progressed. So this basically allows for a lump sum to fall into your bank account to pay for any medical expenses, any time off work that might be unpaid before even an income protection benefit kicks in. So it really is, it's just so you and the family do not go broke while you're going through the fight of your life with some of these illnesses.
I mean, yeah, my sister-in-law just had cancer last year. They just came off the back of having a baby. My brother spent heaps of time, taking personal leave for care for his newborn. And then, my sister-in-law got cancer. So he had no sick leave or, personal leave that he could take. Fortunately, she came through. She didn't pass through. She came through it. She no longer has cancer. But a trauma payment, pretty much, me and my brother, same family situation, we would have had $275,000 in the bank if it happened to us, and they had nothing. So trauma is statistically really highly likely to happen. Just the cancer rates in Australia, they're crazy.
Yeah. And then just a brief overview of income protection, because I've got a whole slide where I'm going to show people how that works.
Cool. If you can't work due to illness or injury, income protection will pay a monthly benefit. So generally 75% of your income is what they pay. There are some nuances with it, but pretty much 75% of your income is paid. Okay. I'm going to just quickly answer a few quick questions. So mental health episodes for trauma, Larissa just asked that. No, it's not covered under a trauma payment. But it is under income protection and disability. So if you can't go to work because of stress, anxiety, depression, then you're eligible for income protection as long as it's covered under the policy. If you could never return to work because of stress, anxiety, depression, then it'll be covered under a TPD payment.
And I'm just going to write on trauma or critical illness, and you can just remember this, not for your mind or spine. So realistically, in terms of the trauma or the critical illness, it just does not cover you, because if you are diagnosed with a mental health condition, that's not considered as a life-threatening event as it would be cancer, for example. In the first instance, or likewise, if you broke your back, severely damaged your back, again, it's not technically life-threatening. So, but yeah, certainly, as Phil said, the disability payments are definitely there for those type of events. Now, our next slide was going to go with how much does it all cost. Now, the worst thing that I see, and I don't blame anyone for doing it because I would want to know as well. But people put in the Facebook group, oh, hey, how much are you paying for insurance? I just got a quote and it was X amount. And the thing is, there's so many different variables where the cost of insurance comes into play. So there's not just like, oh, if you want insurance, this is how much it is. Can I go and get a better deal elsewhere? No, because everyone's a different age, everyone's a different sex, everyone works different, everyone has a different level of cover. There isn't just one insurance company. There's hundreds of policy features, and I'll show you my personal medical or my insurance summary, which will talk about the health loadings. If you're a smoker, it can be up to double the cost. And then every insurance company, no matter if it's life insurance, car insurance, health insurance, it's all got to do with risk. So if you're a white collar professional, a doctor, lawyer, somebody who's, high income earner, in terms of an insurance company, that's the least amount of risk. Then it might go up to an office worker. So if you're working in an admin team, there can be slightly more risk because there is a high chance that you go and pick up a box in the office. Where if you're a white collar professional, there's probably a less chance that you're going to help move a desk around. Then we go up like hairdresser, for example. You're on your feet all day, so there's a higher risk of slipping over. And go up to nurse. You might be lifting people out of bed. Builder, you're on your feet all day. Building. I'm doing bad things with my arm.
Yeah, it's even not even the risk of while you're at work. It's also the risk of how likely are you able to go back to work. Exactly. As a nurse, if you hurt your back, you're on your feet all day. You're not going to be able to easily return to work. But for me, as a financial advisor, I sit on my backside all day long. I can still go to work.
Totally. Yeah. And then interstate truck driver is one of the most high risk occupations. So as you go up, your options can get less for insurance. And then if you were a full-time skydiving instructor, it will probably get to the point where the insurance company says, nah, we're just not touching you because we're going to guarantee pay a claim. It would be like your house is on fire and then you call the insurance company from the front of your house to say, hey, I'd like to insure my house. Like it is a guaranteed claim. So depending on your occupation. And then also it can be for hobbies, do you do any hobbies that we need to pay more for or exclude? So again, there are many issues that make
and I did a rough quote today just before the webinar, and the same person, same amount of cover, same everything other than a few different features. Have you got that in here?
Yeah, here it is. Cool. Yeah. But let me just talk to this step versus level.
Yeah.
So another thing that can affect the premium is step versus level. So there's two options and your advisor would work with you through this. And these options aren't available with direct insurance or group cover, okay? So if someone's 25 years old, and then we've got here a 55-year-old person, a stepped premium means you pay less now, and each year the cost of the insurance will increase because of your age. So if you took $200,000 worth of insurance, each year that $200,000 you would have to pay more for it because your age is stepping up. Now there is a level premium, which and think of it like a fixed versus variable home loan. You pay a little bit more now, but the cost doesn't step up each year with your age. So we pay a little bit more now, but the reason why I personally have all my insurance on a level premium, and Phil does as well, is because once you hit age 50, that is the sweet spot for claims. There's a high chance of all types of cancer, injury, like you just look at the stats. So at the most crucial time in your life medically is the time where you don't want to have to cancel your insurance because it costs too much. So that's why we just have to get good quality cover. And to be honest, if the younger you are, the less of a difference it would be. But, if you were 40 today and wanted to start with cover, it might be, stepped could be here and level could be here. So there's, again, your advisor would help with that. So again, back to what Phil said, talk us through the quote that you did this afternoon, Phil. It's on the
screen. So I did a quote for a 30-year-old, all the bells and whistles on a policy that you can never get, but the amount of cover was exactly the same between both policies. So $1 million of death or life insurance, $1 million of disability, $250,000 of trauma, or income protection of $2,000 per month. Now, income protection, there's a few things to consider, like how long do you need to wait and how long we get paid out for. So that's what we did for the most expensive cover, but all the bells and whistles, level premiums, and that was the other side, was $660 per month. And then I scraped it all out and got rid of all the bells and whistles, made it pretty basic cover, but the same amount of cover. So if you were to die, you'd still get your $1 million. Changed the waiting period slightly to a 90-day waiting period, the benefit period slightly, and got to $118 per month. So and all on step premiums. So you can see that, like, when I speak to people, and it's the same question all the time, because it makes sense. I want to know how much I'm paying for something before I commit to anything. But how much am I going to pay? Well, I don't actually know that until we know just even a little bit about your situation. But when you do speak to an advisor, or you are getting insurance, there is room to move for a lot of it. It's just a matter of a cost benefit. What do you want to achieve? And we can get you that.
Yeah, absolutely. Now, I want to move on and talk about income protection because without a doubt, there is a lot of people who are probably watching this now in Melbourne who might be worried about their income with the COVID shutdowns. So if your income stopped, that's a big issue. So everyone can read, and I'll read it out loud. If you have an income, you need to protect it. If you do not need to protect it, you do not need it. If you do not need it, why are you working for it? Now, there's a couple of things. If you do not need it, why are you working for it? Well, it could be a hobby. It's like, well, I'm cashed up. I'm just working to get out of the house and I like the social benefit. Or, I'm a trust fund kid. I don't need money, but I'm still working. So there's a few percentages there where, people legitimately do not need insurance because they're self-funded. But I think in the main, all of us are working because we need the money to live. And what the income protection does is ensure that if you couldn't work due to accident or illness, that the money wouldn't stop. Now, before I go on to the next slide, I'm going to do another poll. Just gauging the room about how income protection works. Just see, where you're at. Okay, that's. Excuse me.
And I mean, based on the last, not the last poll, one of the polls earlier, only 3% of people either didn't work, didn't have debt, or didn't have dependents.
Yeah.
So not very many people are in that position.
Okay, I'm going to end the poll in 3, 2, 1, and then I'll share the results. There we go. So as you can see, and that's totally fine that 27% have no idea. That's exactly why we're here. That's perfect. 57.
That's why you're joining the webinar. Good job.
That's why we're joining the webinar. And some 57% have some idea, and then 70% they know exactly what waiting periods and benefits are. So basically 30 for the, I don't know, we'll just call it 85, 90% of people that want a bit of a refresh. This is how income protection works. So I'm going to use the example that this person here was earning 65 grand package, including super. Now, if we calculate that on a monthly benefit, 75%, we'll just call it 4 grand a month, and we'll assume 30-day waiting period and benefit period to age 65. Now, how I like to draw it is, and I'm just going to move my microphone because I'm an artist.
He's getting in serious.
Yeah, this is why we're here. Oh, shivers back. So if you're going along earning your 65 grand a year package, and then at this point here, let's say you fall violently ill and have to go to the hospital. So that happened. Probably shouldn't share Phil's information, but Phil had an appendix attack a couple of months ago in really bad pain, and then it all changed in an instant, and he was in hospital. So if you had a bad medical event, or if you broke your leg, or something crazy happened, you broke your wrists or whatever, at that point there, we'll call that the start of the waiting period. And then during this waiting period, and in the example that I'm using, it's 30 days, okay? During that 30 days, there is no claim. You might speak with your advisor to say, hey, it's probably looking like I will be off work for maybe a month or more. At that point, you definitely speak to your advisor as soon as this event happens. And you want to make sure you go and see your GP as soon as possible, because the waiting period actually starts basically when you are unable to work and are under the care of a doctor. So as soon as you see a doctor and you've logged that you're under the care of a doctor. Now, during the waiting period, you're not paid by the insurance company, and there's no back pay. And this is why we want to make sure that we've got holiday pay, sick pay, or an emergency fund. But after that 30 days, you will receive the $4,000 per month, and the insurance companies pay monthly in arrears. But I'll show an example where they might just pay it all in one lump sum. They would continue to pay that $4,000 a month. I'll use the worst case scenario. If you're a hairdresser and you had a bad accident and both of your hands were cut off, okay, and you could never work ever again, you would receive the $4,000 every month until you're age 65 years old. And any good advisor would have the option that every single year you would get a CPI pay increase. So it might be 4,110 the next year each month. So they would pay the $4,000 per month if you could never work again up to age 65, or until you return to work, even if it was that 6 months, or this is not the scale, 4 months, or if you're off work for 3 months, okay? So this is why it's so important to have the income protection. And I've worked with so many different clients and just seen the benefit of this. There are some policies. I had a client, she was in South Korea. She fell downstairs while she was overseas. She broke her elbow. In her policy, a lot of policies have what they call a specified injury benefit, and there's a list of kind of structural things. So under the list is if you break your elbow, there might be 2 months payment without even having to do the waiting period, because the insurance companies know that you break your elbow, you'll be back at work within 2 months or whatever it is. If you fracture your pelvis, they might have a 6 month, there you go, there's your 6 months worth of money. So insurance companies, they want to have less paperwork for them. So there are policies that they just make it really easy when you put a claim in. Now, for example, if you say, Glenn, I've got a fully funded emergency fund of 3 months worth of expenses, what you could do, you might go, well, I want a 90-day waiting period. So you can't put a claim in for 90 days, and that will reduce your premium, because the risk of the insurance having to pay out a claim is substantially decreased, because most claims people are back to work within 3 months anyway. But I can tell you this, and I don't know if Phil, you've got experience about this. Every claim that I've done with a client on a 90-day wait, in fact, the client who broke her elbow in Korea, she was on a 90-day wait, but because she had the specified injury benefit, she got 2 months worth of payments, like at the click of her fingers. We had the payment into her account within 10 days. They did it over the phone. The first thing she asked me, she was freaked out. She says, can I change my waiting period to 30 days? Like every claim I've ever done on a 90-day, everyone's always asked me, can we change it to 30 days? I'm like, sorry, it's too late now.
Yeah.
So that's kind of, and then again, with your advisor, My personal policy is 70 years. And because I'm crazy and rode a motorbike, my waiting period's 14 days. So you can tweak your policy however you want it. And that's why there are so many different variables where a good advisor will ask you about your situation and really tailor the policy. A lot of policies that you have automatically in your super fund might have a benefit period, not to age 65 or 70, but 2 years. A cousin of mine, she was 37 years old. She had a stroke. She only had default insurances in her super. She can't work ever again. And the payment stopped after 2 years, and it was just heartbreaking. But
and the other thing with group cover, the insurance company and the super fund can determine, actually, we're going to change the benefit period now. Mm-hmm. So back 5 years ago, it was pretty common to have a benefit to age 65. Mm. But income protection is getting more expensive. Super funds all decided we want to retain money in our accounts that we can charge fees on. So we're going to change every policy holder, every default policy holder, to a 5-year benefit period or a 2-year benefit period to save the members money, which makes sense. But a lot of them, they can adjust it however they want.
Now, and again, keep your questions coming because we will have a heap of time to answer all these questions.
And there's lots of questions coming in the chat as well.
See if you can open the Q&A section, everyone, not the chat.
Yeah, it's easy if you use the Q&A section.
Yeah.
Because I'm looking at them, there's some ripper questions, but we may accidentally miss them.
Yeah. And then, we will talk about claims and all that, and I'll even share a claim that I had last week.
I've been telling so many people about that.
Yeah. Phil, I've been telling everyone Phil's had his appendix out, and you've been telling everyone Glenn had a bloody trauma payment.
Yeah, that's right.
So how do we pay for insurance? So as it stands at the moment, almost 60% of you have a super fund. Your employer puts 99.5% of your salary into your super fund. And then you might have you might have death cover 120K, you might have TPD of 60K, you might have income protection of $800 a month. Phil, I've never seen a client in the 10 years, and I'm being so brutally honest here, actually I was an advisor for 12 years. In the 12 years I was a financial advisor, I did not see one client ever who had the correct amount of default cover. It was just never enough. Like, put it this way, like if you've got a mortgage and you have default cover, the chances of it just clearing the mortgage if you fell off the perch, it's so low. So we know a lot of you will need a
normally the most we see is like 350 is the high end.
Yeah.
Generally it's like 100 or 250,000 for life and disability. Income protection is always generally low.
Yeah. So this is how we fund our new insurance. Okay. If you've got your direct insurance from the telly, you might have 100K of death cover. You've got to fund that out of your bank account. You can't fund that from the super fund. Okay. Now, how it might work, if you see Phil, he might say, Glenn, I'll just pretend he's talking to me. Glenn, you need 800K of death and TPD cover. So there'll be 800K of death/TPD cover. And usually it's an either or event. So if you had a TPD claim, could not work ever again, here's 800K. Generally, I would lose the death cover because I paid off all my debt. I've got income to live off. I don't actually have a need for death cover anymore.
It's normally more expensive to be TPD than to die.
Yeah. So what Phil can do, and he says, you know what, Glenn, you need 250K of trauma cover, and we're going to still link, to keep the premiums lower, we're still going to link the trauma cover to the death TPD cover. So if you are diagnosed with cancer and a full trauma payment is made, the death and TPD cover will reduce by 250K, which is fine. I've got the view, I want to make sure I'm covered and I don't want to spend all my bloody money on insurance. So I'm kind of happy to have the cover's linked. And then, Glenn, I want you to have income protection at $6,000 monthly benefit, 30-day wait, age 65. But Glenn, because you've said that cash flow is an issue and you want to be tax effective, this death and TPD cover, I'm actually going to fund it with an insurance company and I'll just use an insurance company, MLC, for example, who mine's with. I'm not even paid to say that, but it's just who I'm with. But we're going to fund the premium from your existing super cover. Now, you've told me, Glenn, that what you want in a policy doesn't meet the existing cover that you have, doesn't meet your goals. So we're going to set up this cover first, and we might ditch that, or you've got a health issue, but we still want to just keep this in place. Whatever that is, we're going to make sure that we fund your death and TPD cover from your super fund, and that way this part is tax deductible. I then want you to pay for the trauma cover out of your bank account and your income protection out of your bank account, and then that might be tax deductible there. Trauma cover isn't tax deductible, but the proceeds are tax-free. Anytime the government says something's tax deductible, usually means the proceeds are tax-free. So if you did get that $6,000 a month from your income protection, that's considered income, and you will be taxed on that as well.
What an amazing solution. Thanks, Phil. You're a great advisor.
You're a banger advisor. But Phil, I've got a few personal goals that I want to meet in the short term. I want to save for a house. Are we able to fund my income protection from my super as well at the moment?
Yeah, you can. Yeah.
Okay.
You can do 100% of it through income protection, but ideally you'd want to fund some of the policy outside of super. Yeah. So a lot of policy these days, you can split the premiums. So either 95 or 80 to 95% of the cost of your income protection can be funded through your super fund. And then 5 to 20% of your premiums can be funded outside of super.
Now, there might be people saying, can I fund my trauma cover through super? And the answer is, wait 1 second, I'll show you something. To get money out of super, you've basically got to be dead, disabled, retired, or financial hardship, okay? Now, if I'm diagnosed with cancer, heart attack, stroke, I'm not dead, I'm technically not disabled, and I'm not retired. So the money couldn't get out of super anyway. It would be trapped in super. So it's effectively against the law and not possible to fund your trauma cover through super.
Yeah, there are some people with existing self-managed funds with trauma, but almost no one on this webinar would have that.
No. So I guess what I'm getting at is, with the products that Phil has access to, allows you to structure things in the most awesome way possible. And the good thing about this is that if I'm with XYZ super, and then I want to move my super over to ABC super, I just move my money over. I tell my boss to pay my 9.5% to my new super fund. And then I'll just say, hey, Phil, I need to pay for this cover through here now. And you don't have to change your insurance. Because the risk is leaving it through your default super, as Phil said before, every 3 years, these group policies are tendered. And each 3 years, there might be a crazy price increase because the terms have changed or something's crazy's happened, and you've just got no control for the long term. Yeah.
And the other bit of flexibility is that income protection, you start with it paid inside of super. You can actually go, well, I'm earning a whole bunch of money. I don't want to put any money into super. Let's fund that. Let's get the tax deduction later. Yeah. So you can start with it funding mostly through super, then you can pull it out later with a retail product.
Yeah. So I've got an example here of, and this is a bit old. It was just the first one I grabbed, so bear with me. Phil had a go at me earlier, but
no, I mean this is answering the first. Well, I mean, kind of answering the first question. So the most popular question from Anonymous.
Yeah,
thanks Anonymous for your question. How do you work out an appropriate amount of cover?
So this is a real this is a real case scenario with a husband and wife. And basically, there's no right or wrong way to do this. It's more talk with your advisor about your needs and what your goals are. If you've got children, if you don't have kids. So we'll just ignore this side for now, the spouse too, but we'll just go through the first one. So what we want to do is, if, and I think this was the husband, if the husband could not work ever again, we want to make sure their mortgage is cleared, or if they died. Okay, so they had a bit of debt, $375,000 worth of debt. So worst case happened, the debt's gone. I think they had 3 really young kids. So they wanted an amount if Mr. Spouse here passed away, and I probably shouldn't do that. I might even just do this. If Mr. Spouse here passed away, there would be an amount to produce $40,000 per year for 20 years. So that would enable the, and both of them, it was actually vice versa. It will enable the surviving parent to be debt-free and have 40 grand a year coming in the door to enable them to be a part-time parent or full-time parent if they wanted to. It just gives you options. Medical costs, if they couldn't work ever again, there was $100,000 if we had to put a ramp on the house or do some home renovations or something like that. And then because TPD cover is taxed, we have to allow a provision for tax. Now we say, Mr. Spouse here, yes, he needs $922,000 worth of death cover. That's the total required. But they've got some super and other assets. I think this is all in his super. These are a little bit older, this couple. So we're going to go 922 less 165,000 of super. Basically 750 grand of insurance is needed. In my practice, it was always the view that I'd round up to the nearest 50. So I recommend it, and vice versa with the total and disability cover. I actually recommended $800,000 of death cover, $350,000 worth of TPD cover, income protection, and it's slightly different for the wife. A higher amount of disability cover because her super balance was a little bit less, well, a lot less. Same type of analysis. For trauma, they just wanted 100 grand for medical expenses. So if either of them were diagnosed with cancer, that they could have 100 grand for any out-of-pocket medical expenses. They've had to fly to Germany for the best treatment in the world. They could take the family and do that. In my computer software, I put in an investment return of 7%. Always, I was conservative with the inflation, not that it's that now, but basically, if we invested $547,000 today, getting 7% over 40 years, over 20 years with a depleting capital, they call it, would basically need that much money to fund that. But again, Phil or the other advisor down the road or whatever, there's no right or wrong way. We just need to have some type of science behind what we're doing to recommend levels of cover. I don't personally love the idea of use just a blanket 10 times income or 20 times income. I don't love that because you can actually just go, well, what do we actually want if someone was to die? So do you want to add anything on that, Phil?
Yeah, I was just going to say, just kind of answering Anonymous's question about how much cover. It's really how much do you want? Insurance is a cost-benefit analysis always. Like you're going to have to pay more money for a higher amount of cover. But the way I think about it is I try and just look at, okay, if something was to happen, how do we replace your income and cover a small amount of cost? Because the loss of income and or cost associated with that person passing away or becoming disabled is really important. So for me, the way I calculate this for clients is slightly different, but it's all a matter of like a starting conversation. This is what we think is important.
It just gets us to a talking point, doesn't it?
But really, if something like, I mean, a common one which gets me a bit grumpy is like, oh, my wife's not working, we don't need to cover her. And I look at it, my wife is currently, well, just now not working because of COVID. But in my view, we've got 3 young kids. I want to swim in money if something was to happen to Kate, because I want to just be able to put down everything and just focus on being with my daughters, because that is the most important thing for me. If that costs me an extra few $100s or $1,000 a year in extra premiums, I want to pay for that if the worst thing was to ever happen. So, I mean, personally, I overinsure myself compared to what we ever recommend for clients. But it's what is important to you is the question of how do you get to an appropriate amount of cover?
Yeah. So, and again, it's just these analyses just get us to a talking point. Now, I want to move on to, I guess, underwriting, and kind of loadings and exclusions. And then, it's 8:30 now. So we'll probably spend 15 minutes here, if that, and we'll just spend the last 20 minutes probably answering your questions, because there's some good questions that have come in. So Phil, I've taken the recommendation that you've said, Glenn, you need 800K death TBD cover, 250K trauma cover, some income protection. You then say the insurance company, they'll have to do a personal statement of health. So you have to fill out an application basically, and I have to disclose any health events that a reasonable person would remember about their own personal health. Yep. So what basically happens with loadings, exclusions? Actually, before you answer that, let's do one last poll. I've got an underwriting poll here, everyone. So if you had your default cover in the super fund, so what would happen if someone had a bad wrist and wants to increase their group insurance in their super fund? Your first point is it's likely because you're young and healthy. It's all good because you're young and healthy, obviously. It's likely they would have a wrist exclusion, so your wrist wouldn't be insured, or it's likely they can't get insurance at all. So this is just, you call your super fund and you say, I want to increase my income protection, but I broke my wrist yesterday and it's still playing up. What would be the likely outcome? You like this question, Phil?
It's good. Yeah, it is good.
It's a banger, isn't it? Let's be honest. Yeah.
I know the people who are going to get this right have tried it, is what I'm thinking. Yeah. They've given it a go. They've gone to the insurance company and asked for more cover.
And the questions are coming in a little bit slower, this one, because it's a bit of a quiz.
It's getting a bit later. We're 2 wines in.
2 wines in, yeah. Blah, blah, blah. And just I'll give it 20 more seconds. Just if you can, just raise your hand if you're finding this helpful. Okay, we've got one hand. Sweet. Oh, yeah, heaps of hands. Oh, perfect.
How do we raise hands?
Oh, you can't because you're a moderator.
Oh, okay, cool.
Yeah.
I see heaps of hands. Got it.
Sweet. And the cool thing is, like, this part of what I'm doing now will form part of my new online course in terms of insurance. So, all right. So let's have a look at the poll. I'm just going to end it now. Sorry if you were. Okay, interesting. So 9% said that because you're young and healthy, even though you've got a bung wrist, you would get cover. So that's unfortunately incorrect. The next 62% of people, because they've got a pre-existing issue, they would have a wrist exclusion. So to the 62% of people, that's also incorrect.
Makes a lot of sense, but it's incorrect.
It's incorrect. Because remember, this is just going to your super fund over the phone, or and then it is likely that they can't increase their insurance at all. The reason why, and I had this problem with a client, she wanted to just increase her cover in her Hester super fund or group super. She actually had a bad wrist. There is no mechanism in the product to allow an exclusion, so they have to just decline the whole increase.
Because it's one policy for the group.
It's one policy for the group. They can't tailor it. Now, talk to us, Phil. And we'll get to my one. there's a variety of different scenarios. So, for example, you might have a higher BMI than what you should and what the doctors say you should, and there's been a history of diabetes in your family. That can come into play, can't it?
Yeah. So there's 4 things an insurance company can do. They can accept the cover, no issues whatsoever. Yeah, happy days. We're charging you a premium. You covered. Second thing, they can do an exclusion. So they will say for mental health conditions, if you've had a history of depression or anxiety, we're going to exclude all mental health conditions. If you've had an issue with your left knee, you busted your ACL, we're going to exclude your left knee. Or the third thing they can do is load the cover. So charge you a higher premium because of the increased risk. So the normal things are like family history. So if parents have had cancer and they're under age 50, they'll give you the option of excluding or loading the cover. Things like diabetes, or if you're overweight, they'll say that's a higher risk of cover. Higher risk that we're paying out a claim, so therefore we're going to charge you more. Or the fourth thing they can do is just decline the cover and say, it's too high risk. We're not willing to take on that risk, and it impacts every policyholder that we insure, so we're not taking on that cover.
And
go, mate.
Oh, I was going to say, and if
you stopped talking for all of 1 minute. Sorry, my apologies.
That's why it's called My Millennial Money. Remember?
Yeah, that's it.
Well, no, I just wanted to add, like, if someone wasn't insurable at all, there is the first line of defense is to look at accident-only options. So if you're medically uninsurable, you can get accidental death cover, which costs about 2 cents. And also you can get accidental income protection. So if a claim arises because of an accident, hit by a bus or fell downstairs or something crazy like that, a claim would still be paid.
That was a question someone asked in Q&As, was about that.
Yeah. So again, it can speak to the experience of the advisor and the insurance company's appetite. I had a client once, he was actually a sheet metal worker. He'd actually had a knee surgery in the past. He had no issues for 5 years. We got some doctor's reports. They were happy to still insure the knee. So it wasn't the fact that you've had a pre-existing condition. In terms of back pain, like if you had some back pain and did some physio 5 years ago, the insurance company would be like, oh, if you've had no symptoms since and there's been no surgery or whatever, there probably wouldn't be a problem with it. So
and the benefit, I mean, someone has asked this Q&A, I saw it, that why can't I just go direct and get retail cover myself? And I think it was a question before it. A lot of the selection of product that as an advisor I select, which insurance product, it's all about exclusions and loadings. Like the exact same client, the exact same medical condition, one insurance company will exclude the mental health or back, and another insurance company will accept that risk.
Yeah. And
so different insurers have different assessments on the same exact condition.
And it depends how cheeky your advisor's relationship with the underwriters are. I've wink wink sent a few bunches of flowers to some underwriters, if you know what I mean, in the past.
And it's also business. Yeah, I mean, it's at the end of the day, it's a business.
Yeah.
If they're going to make a lot more money out of the advisor long term, then they're going to potentially be more favourable to that advisor's clients.
I had a bigger case once, and it was I think it was over $5 million of death cover, and there was some health issues with the client, and I basically called the head of insurance of 3 insurance companies because it was a sizable deal. And I said, hey, do you guys want this case or not? What can you do to make it easier for the client? Some insurance says, no, we're just not touching it because we need 50 blood tests and it'll be a loading. Or another insurance company was like, hey, we're hungry for business. Let's do a deal. So again, at some points, it can come down to how good the advisor is at negotiating on your behalf and building the story.
And that is a lot rarer these days.
It is.
Yeah. back in
10 years ago was, I loved it. It was just like
the Wild West.
Yeah. So here is a screenshot and it's bloody confusing, but it's, I think, the second or third page of my insurance renewal that's coming up on the 20th of August. So if you can see here, this is my first portion of trauma cover, and I think the base benefit is around...
Sorry, Glenn, just pause for a second. That's $450,000 of trauma insurance for $1,100.
Yes.
With the 50% loading.
Yes.
That's like crazy cheap.
Yeah.
I took out the cover at your current age.
I set these covers up when I was very young.
So I don't see those numbers at all these days.
No. So I think the cover above here was $600K, I think. I think I got around $1 million worth of trauma cover. It's probably after the fact too much information. But basically, when I took that one out really early, I didn't have a medical issue. Then I went and added the $400,000 of trauma cover. They said, yeah, we can give you $400,000 of trauma cover, but we want you to pay an extra 50% loading because of your health. So I had a...
That was a BMI issue, must have been?
No. Phil, you're a guest here. But if you can... I'm just reading here. Here we go here. So on the TPD cover, and this is a complex setup, but your advisor can... I'm just kind of showing you the conditions. I had some polyps, precancerous polyps removed from some colonoscopies. We're really getting personal now.
Yeah, wow.
So they said for my...
How did it feel when it happened, Glenn?
I was asleep. So they basically said, hey, and this is, again, it's a negotiation. They said, yeah, we're happy to insure you, but you just got to pay 50% more. I said, okay, well, just give me an exclusion on the TPD cover because I'll take the risk that if I have a polyp again, I'll just take the risk that I'm not insured for TPD because I've got my income protection and I've got my trauma cover. So I wanted to pay more. Now, I think they said if I have 2 colonoscopies that are clear, they will review that loading. I've talked about my mental health on podcasts before. I've got an exclusion for mental health on some of my policies. And then I've had 8 ankle operations. You can see it says right ankle there. I've also got a right ankle exclusion. So again, the younger that you set up these policies, like the policy that you can't see above the screen, that policy's really cheap. It's but it hasn't got any loadings or exclusions on it. Where the additional cover that I had on has got because my health's changed, so it's got a loading on there.
Yeah, and also just touch on the bottom area where we've written about the right ankle. It says, we will, however, give consideration to a claim where the medical evidence clearly shows that the claim has not in any way caused by, aggravated or complicated by any condition associated with the right ankle that was diagnosed. So you can still claim on it if it is not caused by, aggravated or complicated by the original thing. So it's mainly like back issues. Like if you have a back exclusion, you're in a car accident, you can still get paid a claim.
Yeah, so they call it the comfort clause. So if I walk downstairs, rolled my ankle, could never work ever again because of my ankle, 1, unlikely, but whatever. 2, as Phil said, if I was in a car accident and my ankle was crushed, well, that was going to happen to anyone, so they would likely pay the claim.
Yeah.
So again, lots there. We've got 20 minutes left. Let's stop sharing the screen and let's answer some questions.
Cool. Do you want me to ask you the questions so you can just talk a little bit more?
No, I'm done.
Oh, cool. How do you work out an appropriate amount of cover? So we've kind of touched on that.
Let's just go to the very top of the Q&A box, Phil.
Yeah.
And the COVID one. I didn't scroll up. Yeah.
Oh, the COVID one. All right. So the amount of cover, we've already kind of touched on that.
Yeah.
But the second one was the income protection. Will you get covered by COVID-19? So this is a good question, asked a lot. if you have COVID and you're unable to work because of COVID, and you for longer than your waiting period, then yes, you'll be paid out a claim. If you lose your job because of COVID and you're made redundant, you won't be paid out a claim, because income protection isn't redundancy payment, isn't because you got fired, isn't because you quit your job, you won't get paid income protection. So, most of the time, unless you're, on life support and in the hospital because of COVID, most people wouldn't be, accessing their income protection because you self-isolate for 14 days and then you're back. But it will still cover you if you pass away because of it, or if you can't work for longer than your waiting period. So, good question.
Emma says, is the death / TBD cover in an income protection included in a super fund sufficient? Well, I think I mentioned earlier, any default cover that I've seen, it hasn't been sufficient. Now, there could be medical events where any additional cover might have an exclusion, and while the group cover isn't the most perfect option, would obviously leave that in place. So that's fine.
Yeah, almost as an advisor, almost always we consider it as a part of your overall insurance options.
Yeah,
but it's good, not great.
Katrina asked a good one. It's a technical question. What are the changes coming up next year, and what are the implications? So, Phil, do you want to talk about guaranteed renewable insurances around income protection and what's happening on 1 July?
Yeah, so...
and it could happen earlier.
Yeah, I don't think it will, but it could. So, there's lots of changes with income protection. There's been some changes this year that have already come into force. But the changes that are proposed for next year is they're removing guaranteed renewable cover. So if you were made redundant because you worked in the travel industry and you couldn't get income protection at the time that you came and had a chat to me, then we want to get income protection before next year, because they're getting rid of guaranteed renewable. So every 5 years, you need to go back to the insurance company and say, hey, can you still cover me? They'll look at your occupation, they'll look at your income, and they'll determine if they're still willing to offer you cover. Currently, if you put in income protection in place, the insurance company can never cancel your policy. So if I'm a financial advisor, I sit at a desk all day, and then I become an underwater explosives expert and a amateur skydiver, they'll still cover me and pay out based on an accident, if I can't work, because it's guaranteed renewable. At the time you take out the cover, they guarantee that cover. Moving forward, that'll always change. So if you're in a low-risk occupation today and you move to a high-risk occupation, so if you're an accountant wanting to be a police officer, they will renew that policy after every 5 years. So, any one takeaway, as you said at the start, Glenn, one takeaway, get income protection in place before 1 July next year.
Yeah, it's a really good one. There's a question here in the chat that I saw before I want to ask. If you put a claim in, how does it affect the future cost of insurance? Well, it actually, at the moment, it doesn't. I don't know what's going to happen post 1 July next year. But for example, we should talk about my trauma claim, shouldn't we?
Go for it.
You want to?
I tell everyone that I speak to about it.
Yeah, okay. So I've got a trauma policy, and they're in the trauma policy, and actually get a question. Go on, Phil, and I'll get up the PDS and share the screen because I'll. But do you want to talk, Phil, about the question about?
All right, denied cover. So Anonymous asked about a denied insurance policy. So that was a retail insurance policy, so not just the default. As we said, default cover to increase. You got a wrist issue or a back issue, they'll decline that claim. If you're going through an advisor, getting a retail policy, and you get denied, there's a bunch of reasons why that would happen. But the other option is accident only. So we did touch on it. So there is cover where they don't look at your medical history. They'll still look at your occupation and any recreational drug use. They'll still consider and decline the cover. But generally, if it's a medical issue that they've declined the claim on, you can look at it accident only as a good option for that. Only covers 40% of claims. But any cover is better than no cover.
All right, so I'm going to share my screen again. Give me 1 sec, everyone. Share screen. And again, this is not an ad for MLC. It just happens to be the insurance company that I use. So my trauma insurance. These are examples. You can see the screen, Phil.
Yeah. We're good.
So the critical illness insurance with MLC, there's about 40 conditions that are covered. So, blindness, so cancer, heart attack.
Just to clarify, that column on the left is standard. So that's a standard contract. The column on the right is a better upgraded contract.
So most of the time your advisor will write a plus policy because the costs aren't that much different.
And you can just see from that it's heaps more cover.
Yeah. So for example, if you're in a car accident and you're in a coma for a specified criteria, and I think it's like over 2 or 3 days in a coma, you would get the full sum insured. If you're in a car crash and you had major burns, the same thing. So, but again, 95% of all trauma claims are cancer, heart attack, and stroke. So if we go to the next page, here are some of the other conditions. Open heart surgery. There's so many. Severe diabetes.
Rheumatoid arthritis.
Yeah.
Common one.
So then basically they've got a thing in the policy called an extra benefits, partial benefits option. So what it means is if you have an event that isn't as life-threatening, but still potentially life-threatening or potentially bloody annoying or costly, you can basically claim on your insurance. And usually it's about 20 to 25%. MLC is 20%. Of how much of the policy you've got to a maximum, okay? So, for example, if you went deaf in one ear or had early onset diabetes, you would get a 20% claim. If you, for the ladies, and I guess a very small percentage of men, if you had a carcinoma in situ of the breast, that's a 20% claim. Now, I actually went... I think it was 3 weeks ago now. At the start of the year, I just had this gut feeling that I needed to get a skin check. Like it was just, I don't know why, just a gut feeling I've got to get a skin check. And then COVID hit and I'm like, I can't be bothered going to a bloody doctor because of COVID and all that. And then finally 3 weeks ago, I went, maybe 4 weeks ago now, I went and got a skin check. And I said, while you're here, can you take a thing off my face just because it's superficial and I didn't want it there? And he goes, yep, we'll take the thing off your leg. That looks weird. Won't be anything. We'll take a mole off your arm. It looks weird. Won't be anything. But come back next week for your face. I went back the following week and said, hey, I'm here for my face. And they said, oh, no, we've got you in here for your left leg. I'm like, what do you mean left leg? And I said, it must be a mistake. Anyway, the doctor came in. He said, hey, we actually took a melanoma. It was a melanoma. The lab came back. So I instantly thought, that's a bloody partial benefit to do insurance.
The advisor in you.
Stop talking, doctor. I'm busy calling to get my money. So basically, I had an early stage melanoma. So I got 20% to a maximum of $20,000. So the long story short is before the stitches were out, I had the $20,000 in my bank account. And it's kind of weirdly, I thought that's kind of not needed. But then, like, I think Deborah Hutton just was on the news and all that. She had a melanoma or something on her face. And I said to somebody, I'm like, well, if it was on your face, you might need to spend 10 grand to get cosmetic surgery. So it actually freaked me out that it's like, what if I didn't go and get a bloody skin check? Like, what would happen in like 2 years? Would I get sick and then, because the symptoms are way too late. So I've got to go in 3 months and 6 months. But all that to say, I had a claim. I didn't think I would. And yeah, now I had a friend. There's a partial benefit there, specific complications of pregnancy. She had, and I'll just try and find it. Do you want to say something, Phil? While I
do we want to? We'll answer some questions. What level of income should you start looking at retail insurance? My personal view is if you need your income to survive, then you need to protect it. And so therefore it should be any time. As soon as you're earning an income, the earlier you get it, the younger you get your cover, the better it will be long term. Less exclusions, long term cheaper. So in my view, you should starting to look at it straight away. Mm-hmm. In terms of the cost, that example of that we talked about at the start, where you can basically scale down the cost significantly if you really need to from a affordability. You can also fund a lot of it through your super fund. So setting it up today through your super fund, even though not much is going into your super to pay for it, your balance can fund it until your income catches up. There's lots of options when you speak to an advisor when you speak to an advisor, they'll talk about heaps of options. Do you want me to keep going answering questions, or are you going to talk?
Yeah, well, I just found this on the screen. The partial benefit for trauma. A friend of mine, I had lunch with her one day. She says, "Oh, sorry, I was frazzled the other day. I actually had an ectopic pregnancy," and instantly she was a client. I'm like, that's a claim. So I didn't tell her at the time. I just went back to the office and called the insurance company and confirmed. And I think she got 120 grand from her policy because of the ectopic pregnancy. And it just took a lot of pressure off her and her husband, took some time off work. And it was a great thing. So yeah, I can't speak highly enough of good quality insurance.
And does mental health condition affect your insurance premiums? So no, it won't affect your premiums. It'll just impact the cover. So you'll have an exclusion on the policy. Again, exclusions, we didn't talk about this. Exclusions can get reviewed later. So it's locked in at the policy, but then you can look at reviewing it. So if you have a history of, depression at a point in time, and then, you're not finding any symptoms or treatment over the next 5 years, 10 years, you may be able to get that removed. So it doesn't impact your cost, just impacts the quality of cover.
There was a question here about double dipping. The last claim that I had with the client, he was a builder, which is irrelevant really. He was diagnosed with cancer, I think lymphoma. It's funny, when clients calls you on a Saturday night, you answer the bloody phone because something's wrong. Because on that Monday I was at Gosford Hospital with some trauma claim forms. But basically how the events progressed were we got him trauma payment, because it's payable on diagnosis. So you have the cancer event. Yes, it's cancer. Yes, it's heart attack. It's pretty black and white. Get a doctor to fill out the form. Within, a couple of weeks, the money's in their account. Okay. Then he's still off work after 30 days. Then we trigger the income protection because that's a separate policy. So that's still getting paid. Trauma policy's gone. And then it actually progressed to basically they said you've got a terminal illness and you're likely to die within the next 2 years. And we put a terminal illness claim in for, I think, $1 million and got that paid. But he's still alive. He's still on income protection.
You don't need to pay your money back.
If he survives, that's his money. And if he survives, the claim would stop with income protection. They still can't cancel the policy. And then in 10 years' time, you could get cancer again and then claim again on the policy. So,
yeah.
There was one there about suicide, and I'll just I'll talk to that quickly. There is a clause if you do take out a life policy, you are not covered by suicide within the first 13 months of a policy. But after that 13 months, you certainly are. And I'll just say to that person the anonymous person who wrote that question, please reach out to Lifeline or anyone if you're having any issues. I don't have the number on me, but please Google Lifeline.
31111, is it?
Yeah, if I might just get Phil to bring that up. There was a question here. Can you get more than one trauma critical illness payout? Yep. If I had a policy, and I'm actually going in underwriting at the moment with Phil to get a policy that my podcast company will own, and that would still pay. There's limits that insurance companies won't let you go more than, I think, $2 million for trauma, but certainly can.
131114.
Yeah, 131114. Please write that down. 131114. If you are going through a hard time, I want to have a chat with somebody. But thanks for asking that question.
And just to touch on that again, so mental health exclusions, they don't exclude that on life insurance as well. So
because it's not a claimable event.
Yeah, exactly. But if it leads to suicide and you've had the policy for a while, it can. Again, it's a pretty depressing topic, obviously, but I did have a client, an ex-client, who cancelled their policies because she was not working. And, we don't need to insure my wife because she's not working. And she ended up committing suicide, and I felt sick for a week because, I tried to convince them to keep it, but she didn't. So that, I guess, another reason why I'm so passionate about making sure you're insuring the non-working spouse.
Totally. And we've got 1 minute, but we might just please feel free if you've got to leave, but we might just spend 2 more minutes answering some of these other questions really fast. Douglas asks, if you purchase an insurance policy while in a white-collar job but move to a blue-collar job a few years later, will the policy and premium have to change? No, if you get it set up now. But if you want to increase the cover in the future, they will underwrite your situation at the time. And thanks to Christy, who's put some phone numbers in the webinar chat if anyone needs to have a chat with somebody. Emma asks a question, is death cover only important if you have dependents? And there was another question that, I didn't even get to this list, that it reminded me. Vicky said, I spoke to a financial advisor recently and they said it wasn't worth getting the trauma TPD insurances yet as I don't have dependents. Thoughts? My thoughts is to fire that bloody financial advisor because they're being lazy or they're just, I don't know. I don't know the situation, but I think I have $1 million of death TPD trauma cover. I'm single, so I'm not married. I don't have kids. So I don't need death cover, okay? I need TPD cover and trauma cover. So if I couldn't work ever again, I want to make sure the debt's paid off, I've got money in my life. It's actually just better, I believe, and it can be cheaper in some instances to just link it with death cover anyway.
Especially with MLC. Yeah, you would have gotten it cheaper.
Yeah, because number one, you don't pay stamp duty on a death policy in Australia. So if you had a TPD and trauma policy standalone, as they call it, you'd pay stamp duty, but also just the internal packaging discounts. And then maybe one day we'll need death cover. So at the moment, if I checked out early, my family will get an extra big bonus.
Monique's asking, if you engage in a financial advisor and you put in place insurance, they paid by the premiums, commissions, or do they charge separately? Great question. So commission rates are coming down a lot for advisors. So some advisors are starting to do a combination, charge you a small fee and the commission. I personally do that. I charge a small fee to do the initial engagement, and then then we get paid a commission from the insurance company.
But you'll so for anyone chatting, you'll obviously have a chat with anyone just to point them in the right direction and say, yes, I think I can help. And you'll do that with no cost, obviously. But if you're going to pick up a mouse pointer and clicker, you charge a small commitment fee.
Yeah, so we do a 15-minute phone call to whoever wants to chat and listen to me waffle on about insurance. But then, if we do any work, we just charge quite a small commitment fee. For that time,
And there's still a high engagement rate. We've had hardly any drop-offs. So I will say, if you do want to chat to Phil, go to sortyourmoneyout.com, click Get Help, and just put name, your details in, and just tick that you you found out about us through the webinar, and even in the notes at the bottom say, I want to talk with Phil. Phil will, whatever his commitment fee is, you'll do a half price or something for anyone on this webinar.
For you, my friend, I will. Yeah.
Love it.
When you're on the phone with me, tell me. I was on the webinar.
Yeah, so just make sure,
amazing, Phil.
If you're talking with Phil, and but definitely pick up the phone. What kind of questions do they ask when getting retail insurance? Like, how often do I go to the doctor? How often should I be going to the doctor? So they'll basically say it's a personal statement of health. So there'll be a variety of questions. There's a catch-all question. They're not that intimidating. It says, like, when did you go to the doctor last time? And it might ask you a couple of questions. I mean, you're better off to take the time now rather than being in hospital with your leg in traction and trying to negotiate with a direct insurance company to prove that your ankle hadn't been broken before.
Yeah. And a good advisor will take you through that process. We'll ask some basic questions up front so they can get a good understanding, because your health history has a huge impact on which products is best suited for you. So a good advisor will help you with that. We'll go, hey, give us a good understanding so we can kind of preempt it, because there's no point saying, hey, you're going to get charged, $1,000 a year, but then get to the end and you get told you got in 5 exclusions and a loading of 100%. That's the worst case scenario.
Anonymous said, I plan to buy a house in the next 6 months. Is it worth seeing an advisor now for my insurance, or should I wait? Look, if it was me and you're healthy, I'll just set up your insurance now. One less thing to do. If you know that your mortgage is going to be $400,000 or $500,000, you might just say to Phil, can you include that in the analysis? And then even if you are renting for the next couple of years, I would still include in the analysis an amount to buy a house outright with cash. So if someone couldn't work ever again, I want them to have their house that they own outright. So that's the right time to chat is now.
The perfect time to chat and get the policy in place is just before the accident.
Yes.
You never know when that's going to happen. So my view is insurance premiums don't have a huge impact on your serviceability. So if you want to borrow $400,000 and you're just at that level, then when you talk to the advisor, say, hey, I want to borrow $400,000. I'm only just at the income level. I can't increase my expenses. Okay, fantastic. Let's set it up today and have no impact on your cash flow. We're not going to have trauma cover, but that's right. We've already done the underwriting to increase that. Once you do buy the house, you just write a statement of good health, and then we can include it later once you've bought the house. A good advisor will help you through that.
There's a question here. Does death cover cover accidents? Does death cover accidents? Yeah. Are accidents, e.g. death/TPD, insured that you're overseas? So, yes. Any advised policy. So if you fill out an application with Phil and said, I'm holidaying in Iraq next month, they'll say, that's fine, but we're excluding Iraq, okay? Because there could be some weird activity going on over there. Or if you said, I'm going to the jungles in Vietnam. So the insurance company is basically on the DFAT website. But in the main, you are covered 24/7 worldwide. I had a client once who died on the ski fields in Canada. Would have been the worst flight home. His wife had to fly home with the body underneath, but we did the death claim. And and a small trick for young players, NRMA had an income protection policy, and because they're just so helpful, Phil, they just want to help. Their income protection policy, I read in the fine print that it said, if you're doing holiday activities overseas and you're injured, we're not covering you. AKA, if you're on a motorbike in Bali and fall off, or going paragliding and have an accident, you're not covered.
Yeah.
But
there's other things where you need to be back in Australia before you get paid out. A lot of default cover will have those clauses. Yeah. We won't pay you a death claim unless you're back in Australia, or a TBD claim.
I'll finish with this story. I had a client, they moved to LA for I think 6 years. And they said, what should we do with my income protection? I said, keep it. As long as you pay for it, it's in force. and actually moved back to Australia now. And they've still got the policy. Anyway, he had a car accident in LA and was off work for, I think, 6 months. And the insurance, and I'm happy to praise any good insurance company. And the insurance company was actually MLC. I put a lot of business with MLC because I knew they paid claims. And basically he was off work and they said, okay, we've booked you in with a neurosurgeon, independent, go to them. Neurosurgeon said, yeah, this guy can't work, blah, blah, blah. Long story short, he went in America, osteopaths and chiropractors, they use the word doctor. He went to a chiropractor for the first 3 or 4 months until he saw this neurosurgeon and put the claim in. He technically didn't meet the definition of being under the care of a doctor, but he thought he was because he went to the chiropractor. But because he actually legitimately hurt his back, and this is in America, like overseas, the insurance company had every right to say, we're not paying and you've got to come back to Australia and be treated by an Australian doctor. But I guess developed countries like the United States and, reputable countries that have good medical systems, like I don't know if they would allow it in Southeast Asia, for example. But anyway, they paid the claim. It was a $60,000 deposit, 6 months off work, bam, 60 grand into his account while he was in America. Like, it just blew my mind.
Yeah. Shall we quick fire some of these questions as well?
Yeah, and then I'm going because Yellowstone's released on Stan at 9 p.m. on Monday nights.
Cool. All right. Some people have questions, and I've been listening to your stories, hoping that you get to their questions finally. So I'll get to their questions. Income protection while on mat leave. Do I need to reassess it and change it when I go back to work? Complicated question. Go have a chat to your advisors. Some insurance companies will say, we'll assess your income at the time that pre-mat leave. So if you're off work for 5 years, they'll still pay out an income protection claim. Some insurers have funny rules where they'll only pay out if you're on mat leave for less than 3 years. So generally keep it. If you go off work for a year and you go back to work, don't need to reassess it unless you're going back part-time. But yeah, definitely have a chat to your advisor about that. Given medical history limits me accident only, what's the best way to self-insure? Self-insurance is just save an emergency fund for, 25 years worth of expenses.
We're going in 2 minutes. I'm calling 2 minutes.
Is it financial absolutely necessary to find a good personal insurance, even if you're just looking to get one of them, i.e. income protection? An advisor will help you get income protection only. So that's no issue. No issues. Can you change your level of insurance over time without losing exclusions? Yeah, you can change it over time. So your base cover, like Glen's, his base cover doesn't change. His trauma cover doesn't have any exclusions. But when he added more on, an extra $450,000, they added an exclusion on. So you can set it up that way. When I work with clients, we work for the long term. We look forward and go, how do we set it up properly? But you can always adjust it later.
And quickly, last one, because we're over time, because I chat.
Start on step premiums, then move to level later. You can't game the system. So if your level premiums are $100 per month today, and then you want to change it in 10 years' time, it would be $200-$300 at that point in time. So you can't game the system. You can't start on stepped, and then when the crossover period changes, then move to level. It doesn't work that way. But definitely get advice on this. As Glenn has said, go to sortyourmoneyout.com, click get help, fill out your details, and Glenn will put you in touch with a good advisor and also me.
Do you know any, Phil?
Yeah, I'll try and introduce you to some when I find some.
So remember, don't compare yourself to anyone else because it freaking means nothing. An advisor will help you navigate medical conditions and give you options if you can't get insured. Different insurance companies have different sweet spots. I know, ComInsure, like Commonwealth Bank's insurance company, which they've since sold, they were the go-to for pilots. So every advisor who had a pilot you'd send them to CommInsure. MLC would send all police officers there. So it's just, and a good advisor knows sweet spots. And of course, reach out to Phil. Next,
I'm in the Facebook group. If you've got any questions, you can just ask me a question.
Yeah. In a couple of weeks, we're actually doing a webinar just around health insurance. So I've got a guy from AIA, Vitality Health Insurance, coming on. So he can just answer all the hard questions. And then next Monday night, Shell and Em are doing another webinar with careers. So that will be fabulous. So after tonight, I'll send you an email. I'll also basically ask that you can give us some feedback. In fact, I'm going to put the feedback link in the chat now. So if you do have time, because we really like to, can you say something, Phil? I can't.
Yeah. All right.
Bubblegum.
All I'm saying, it was a pretty depressing subject. Insurance is super depressing. But as Glenn said at the very start, the foundations, 100% insurance is the foundation of any wealth plan. I don't want anyone to come and talk to me and tell me how many investment properties they have if they don't have insurance, because you're going to have to sell them all and live on nothing if you don't have insurance. I'm pretty harsh when I talk to clients about it. I don't care how much insurance you have. I don't care how much you want to pay, because we can get to the numbers, but insurance is really important.
Yeah. So if you open the Zoom webinar chat, you'll see that I've put the link there to the feedback. So yeah, we really want to make these webinars valuable. And I know we've gone a little bit over, but I can just look at the numbers, and we kept everyone's attention and it wasn't dwindling. So thanks so much, everyone, for coming. Thanks, Phil, for
thank you
coming along. And the funny thing is, like, no, we should do an after party.
An after party.
You want an after party?
What were you going to say? You've been talking. We've got 91 people still here. They've been listening to you waffle on this whole time.
I know.
What do you got to say?
Some of the feedback is like, some people are like, you just got to know, like, anytime you give feedback of what you think, there'll always be someone who will give the complete opposite, and that's why I can't ever please everyone.
But be opinionated in your feedback.
Yeah, whatever. But someone will write like, "Oh, I would rather a free webinar with a sponsor," and then they'll write in the comment, "Oh, I didn't like the sponsor." Like, they didn't like the sponsor. They didn't like. Oh, it was just like, yeah. Anyway, I just don't. I like reading them all, and yeah, I'm gonna go watch Yellowstone now. So
thanks for coming, everyone. Exciting talking about insurance. Very exciting topic. Thanks for having me, Glenn.
No worries. I'll see everyone soon.
Cool. Bye.